Right. Here we are again. Tax season's looming, or maybe it's already here for you. And you get to that moment, right? You're staring at the tax software. Maybe it's a paper form, and there it is. What is your filing status? And you kind of pause. Does it really matter? Is it just some box I check?
Oh, it doesn't just matter. It matters. Well, profoundly, actually. It's probably one of the most fundamental choices you make when you're doing your U.S. taxes for the year.
Really? That fundamental?
Absolutely. This single choice, it basically sets the stage for everything else on your return. It tells you, which forms you might need, what your standard deduction amount is going to be, which tax brackets your income falls into.
Okay.
And maybe most importantly, it determines if you're even eligible for a whole bunch of tax credits and deductions that could, frankly, save you quite a bit of money.
Wow. So it's not just ticking a box. It's like a key that unlocks or locks different parts of the tax code for you.
That's a great way to put it. It's really the bedrock for calculating your tax liability. If you make the wrong choice, or you just don't really understand your options, you could easily end up paying more tax than you legally need to.
Okay, well then we definitely need to unpack this. Today, we're taking a deep dive into these different tax filing statuses available in the U.S. We've gathered quite a bit of material for this. The official stuff from the IRS, like their Publication 17 and Publication 501, which are kind of the ultimate source.
The final word.
Right. But also looking at insights and like practical examples from financial sites, NerdWallet, Investpedia, Smart Asset, places like that.
And I think, crucially, we've also dug into some real-world questions, discussions happening on places like Reddit where people are genuinely grappling with these rules. Okay, I'm in this situation. What does it mean for me?
Yeah, that's where the rubber meets the road, isn't it?
Yeah.
Seeing how these rules play out in messy, real life.
Exactly. Those questions really highlight the common pain points and where the confusion usually crops up.
Perfect. So that mix the official rules, expert takes, real-world confusion. That's our mission today. We want to help you understand the main filing statuses: single, married filing jointly, married filing separately, and head of household. We'll lay out who qualifies for each one, get into how they actually work on your tax return, and really focus on what they mean for you financially. The goal is for you to face tax time feeling more confident, clearer, and maybe even save some money.
Yeah, understanding these rules really empowers you and lets you make informed decisions, and that's the core of managing your finances well.
Couldn't agree more. Okay, let's dive in. Where do we start?
Well, let's start with the absolute basics, the foundational rules. The IRS generally recognizes 5 main filing statuses.
Okay, 5. And those are the ones we usually see listed, right?
Yeah.
Single, married filing jointly, head of household, qualifying surviving spouse, and married filing separately.
That's the list. Now, the single most critical rule, the one that sort of gates which of these you might even be eligible for, is your legal marital status on one specific day, December 31st of the tax year.
December 31st. That specific date.
That specific date. It's absolute. Whatever your legal status is when the clock strikes midnight on New Year's Eve, that's your status for the entire tax year, all the way back to January 1st.
Wait, so if I get married on, December 30th, the IRS considers me married for that whole year?
Precisely. For tax purposes, you are married from Jan 1st to December 31st. And, the flip side is true, too. If your divorce decree is finalized on December 31st, you are considered unmarried for that entire tax year.
Wow, okay. That puts some serious pressure on getting year-end paperwork done, or not done, depending.
It really can. The timing matters. So if you are legally married on December 31st, the general rule is you have to file using one of the married statuses.
Okay, so no choosing single if you're married?
Generally, no. Your options are married filing jointly, where you file one return together with your spouse, or married filing separately, where you each file your own return. You typically can't choose single or head of household if you're legally married at the end of the year.
Typically. Are there exceptions? I feel like there's always an exception in tax law.
There is. There's one really important specific exception that lets certain married people be treated as unmarried for tax purposes. This can potentially let them qualify for head of household status.
Oh, okay.
We'll definitely dig into that when we talk about head of household because it's a key point from the sources. But for most married folks, yeah, the choice is just jointly or separately. And importantly, the sources are very clear this applies equally to same-sex marriages as long as they're legally recognized.
Got it. So married on December 31st means MFJ or MFS. Legally divorced or annulled by December 31st means unmarried for the whole year.
Exactly. And if you fall into that unmarried category by December 31st, then your potential statuses are single, or if you meet the extra requirements, head of household.
Okay, that December 31st snapshot is crystal clear now. Let's just hammer home again why this choice matters so much. It's not just a label.
No, not at all. Because, like we touched on, your status directly impacts several really key parts of how your tax is calculated. First off, your standard deduction amount.
Right, the amount you get to subtract right off the bat if you don't itemize.
Exactly. It's a fixed dollar amount the IRS lets you take off your adjusted gross income, or AGI. And these standard deduction amounts, they vary a lot depending on your filing status.
And most people take the standard deduction these days, right? Since the tax law changes a few years back.
That's right. The vast majority do. So for many, many people, the standard deduction tied to their filing status is the single biggest factor reducing their taxable income.
Okay, what else?
Second, your filing status sets the width of the income tax brackets that apply to your income. Each status, single, MFJ, HOH, MFS, has its own set of income ranges that get taxed at different rates, 10%, 12%, 22%, and so on.
Wider brackets are better, generally.
Generally, yes. Wider brackets mean more of your income gets taxed at those lower rates before you hit the higher ones. So the same amount of income could potentially face a lower overall tax bite under a status with wider brackets.
So my $50,000 could be taxed differently depending on if I'm single versus, say, head of household.
Precisely. That same dollar might fall into the 12% bracket under one status, but maybe the 22% bracket under another. The bracket structure is a really key difference. And third, your status impacts your eligibility for, and sometimes the amount of, many tax credits and deductions.
The credits and deductions again.
Yeah, some are just flat out unavailable if you file under certain statuses, like married filing separately, for instance. Others have income limits where they start to phase out, and those limits are often different depending on your filing status.
Okay, so it hits your standard deduction, your tax rates via the brackets, and your ability to claim specific tax breaks. It really does shape the whole calculation.
It absolutely does. Now, sometimes it's pretty clear which status applies to you. If you're single, never married, no dependents, you're probably filing single. If you're married, you're likely looking at MFJ or MFS.
Right.
But there are situations, especially for unmarried people, where you might technically qualify for more than one status, maybe single or head of household. In those cases, the goal, as the IRS and all the financial guides point out, is usually to choose the status that results in the lowest amount of tax you legally owe.
Lowest legal tax.
Makes sense.
Yeah, the IRS even has tools and interactive questionnaires on their website to help you figure out your correct and usually most beneficial filing status if you're unsure.
Good to know. Always aim for the lowest legal tax bill.
That's the smart way to approach it.
All right, foundational rules down. December 31st is key. Status impacts deduction, brackets, credits. Let's get into the specific statuses, starting with the unmarried folks, single and head of household.
Okay. Single filing status is sort of the default for unmarried individuals.
Who's using this? Pretty straightforward. Generally, yes. The single status is for anyone who is unmarried, divorced, or legally separated according to state law as of December 31st, and who doesn't qualify for any other filing status, like head of household or qualifying surviving spouse.
So if you're unmarried and don't have qualifying dependents or meet the other tests, you land here.
Exactly. When you file as single, you're filing your own return. Just your income, your deductions, your credits, your financial picture is totally separate.
Now, you mentioned earlier something the sources brought up about trick divorces.
Ah, yes. The IRS and the financial guides do warn about this. It's this idea where a married couple might get a divorce finalized right before the end of the year, say December 28th, purely for tax reasons maybe, so one or both can file as single, or maybe try to qualify for head of household.
With a plan to just get remarried in January.
Exactly. They intend it to be temporary, just to manipulate their filing status for that one tax year. The IRS knows about this tactic. If they determine the divorce was a sham, lacking genuine legal substance beyond tax avoidance, they can disregard it and require the couple to file using a married status anyway.
So don't try to get cute with year-end divorces just for tax savings.
Definitely not advisable. It's not a legitimate strategy.
Okay, so for legitimate single filers, what are the main financial characteristics we should be aware of?
Well, the big one, especially when you compare it to married filing jointly, is that the tax brackets for single filers are generally narrower.
Meaning your income hits higher tax rates sooner.
Correct. For example, looking at the 2024 tax brackets, the 22% bracket kicks in for single filers once their taxable income exceeds about $47,000. For a married filing jointly couple, that same 22% bracket doesn't start until their combined taxable income hits over $94,000.
Ah, okay, so that ties into that marriage penalty idea we sometimes hear about.
Yeah. It does, although it's often more of a marriage bonus. But yes, while filing jointly is usually better, especially for lower and middle incomes, there's this potential penalty at the highest income levels.
How does that work?
The sources gave a good example. Imagine two people, each earning a taxable income of, say, $375,000 in 2024. If they file as single, their income goes up into the 35% tax bracket. The top of that 35% bracket for singles is way up there, over $600,000. So both of them stay within that 35% bracket.
Okay, makes sense.
Now, let's say they get married and file jointly. Their combined taxable income is $750,000. Well, looking at the 2024 brackets for married filing jointly, the highest bracket at the 37% rate actually starts at an income level just over $731,000.
Ah, I see where this is going.
Right. Their combined $750,000 income means that almost $19,000 of their money, $750K minus $731K, gets pushed into that top 37% bracket. If they had stayed single, all of that combined $750K would have been taxed at 35% or lower.
So getting married actually costs them more in tax in that specific high-income scenario.
Exactly. That's the marriage penalty in action. It tends to happen when two high earners with relatively similar incomes combine them. But again, for most couples, especially those with disparate incomes or lower moderate incomes overall, filing jointly usually results in less tax, the marriage bonus.
Interesting how it cuts both ways depending on income levels. What's the standard deduction figure for single?
For the 2024 tax year, the taxes you file in 2025, the standard deduction for single filers is $14,600. For the following year, 2025 taxes filed in 2026, it's projected to be $15,000.
Okay, $14,600 for 2024. That's the baseline deduction for unmarried folks who don't qualify for anything else. But there is something potentially much better for some unmarried people, right? Head of household.
Absolutely. Head of household, often abbreviated HOH, is a really valuable status. It's specifically designed to give a tax break to individuals who are generally unmarried but are bearing the main financial responsibility for supporting dependents and maintaining a home.
So it offers more tax relief than singles.
Significantly more, yes.
Okay.
It's generally considered much more favorable than filing single.
Okay, so who gets this more favorable status? What are the key requirements?
There are basically three main conditions you have to meet, and you have to meet all of them. First, you generally must be unmarried or considered unmarried on the last day of the year. Second, you must have paid more than half the cost of keeping up a home for the year. And third, you must have had a qualifying person live with you in that home for more than half the year.
Okay, unmarried, paid more than half the home costs, qualifying person lived there more than half the year. It sounds like more than just being the head financially.
It is. The sources really emphasize this point. You can't just claim it because you earn the most money. You have to meet these specific IRS tests about your marital status, your financial contribution to the household running costs, and the residency of a qualifying dependent.
Let's break those down. First, that unmarried or considered unmarried part.
Right. So typically this means you were divorced, legally separated, or never married as of December 31st. But this is where that important exception comes in for married people.
Ah, the one you mentioned earlier.
Yes. You can be legally married but still be considered unmarried for head of household purposes if you meet all of these specific conditions. 1, you file a separate tax return from your spouse.
Okay.
2, your spouse did not live in your home at any point during the last 6 months of the tax year, so from July 1st to December 31st. Temporary absences like for work, vacation, medical treatment, or military service don't count. They have to have truly lived apart for that last half of the year.
Less 6 months living apart. Got it.
3, you paid more than half the cost of keeping up your home for the entire year.
All right.
And 4, your home was the main home for your child, stepchild, or foster child for more than half the year, and you can claim that child as your dependent, or could, except a non-custodial parent is claiming them under specific divorce rules.
Oh, that's a very specific set of rules, but incredibly important for someone who is separated but not yet divorced, right? You could let them file HOH instead of married filing separately.
Exactly. If they meet all those tests, they can use the much more beneficial head of household status, even while still legally married. It's a lifeline for many separated parents.
Okay, that's the unmarried test. What about the qualifying person requirement? Who counts?
This is usually a qualifying child.
Mm-hmm.
The rules here are very similar to the general rules for claiming a child as a dependent. The child generally needs to be your son, daughter, stepchild, foster child, sibling, step-sibling, half-sibling, or a descendant like a grandchild, niece, or nephew.
Okay, relationship test.
Then there's the age test, under 19 at year-end or under 24 at year-end, and a full-time student for at least part of 5 months of the year. There's no age limit if the child is permanently and totally disabled.
What about that Reddit question, a kid turns 18 but is still in high school?
Yep, they still qualify under the under 19 rule, assuming they meet the other tests. If they were, say, 19 but still a full-time student, they'd qualify under the under 24 and student rule. The sources confirm this is common.
Okay, age test. What else for a qualifying child?
Residency. The child must have lived with you for more than half the year. Support. The child must not have provided more than half of their own support during the year. And citizenship presidency tests usually apply too.
So relationship, age, residency, support. The main dependency tests.
Pretty much. Now, it's not only children who can be qualifying persons for SS.
Oh, who else?
Certain other relatives can qualify, but usually they have to meet the qualifying relative rules, which include things like an income limit and you providing over half their support, and they generally must live with you all year. The big exception here is your parent.
Your parent. How does that work?
Your mother or father can be your qualifying person for head of household, even if they don't live with you.
Really?
Yes, provided you pay more than half the cost of keeping up the home where they live for the entire year. This home must be their main home. Or, if they do live with you, you just need to pay more than half their total support.
That's huge for people supporting elderly parents living elsewhere, like in their own apartment or maybe assisted living.
It's a really important, often overlooked provision. Siblings, in-laws, etc. might qualify, but the rules get much trickier, usually involving living with you all year and meeting those qualifying relative income support tests. IRS Publication 501 is your friend for those complex cases.
Okay. What about that other Reddit scenario, the person asking about claiming their girlfriend and the girlfriend's child?
Right, another common situation. Here's the breakdown. The girlfriend's child might be a qualifying person for you if they meet all the tests relationship, maybe as a stepchild if you were married or potentially just living with you, age, residency, living with you half the year, support. Child didn't provide half their own. If the child qualifies you for HOH status, great.
But what about the girlfriend herself?
The girlfriend herself generally cannot be your qualifying person for head of household unless she meets the very specific definition of a qualifying relative. This is tough. It usually means her gross income has to be below a certain threshold, around $5,000 for 2024. You have to provide more than half her support, she has to live with you all year, and your relationship can't violate local law. In most cohabiting situations, the partner themselves won't make you eligible for HOH. The Reddit thread confirmed this focus on whether the child qualifies.
Makes sense. And the autistic young adults question.
That falls under the permanently and totally disabled exception to the age limit. If an individual meets the IRS definition of disability, they can be a qualifying child or qualifying relative regardless of age, as long as the other tests like support and residency are met. The sources noted this allows dependents over the usual age limits to qualify someone for HOH. Of course, you need to properly document the disability status according to IRS rules.
Okay, so unmarried or considered so, check. Qualifying person, check. The last piece is paying more than half the cost of keeping up the home. What costs actually count for that?
This is about the costs of running the household. The IRS and the guides list things like rent or mortgage interest, property taxes, home insurance, repairs and maintenance, like fixing the furnace or plumbing, utilities, gas, electric, water, trash, basic phone service, and food consumed in the home.
So groceries count.
Yes. Food eaten at home counts towards keeping up the home. You have to add up all these types of costs for the year and then show that the amount you personally paid was more than 50% of that total.
What doesn't count?
Things directly related to the person, not the house. So clothing, education expenses, medical bills, life insurance, transportation costs, those are generally considered support costs for dependency tests, not keeping up a home cost for HOH qualification. Keeping good records of your payments for rent, utilities, repairs, and food is key here.
All right, so if you can tick all three boxes, unmarried, considered unmarried, qualifying person, paid 50% of home costs. What's the payoff? Why is HOH so much better than single?
Two big reasons. A much larger standard deduction and wider tax brackets.
Let's see the numbers again. Standard deduction for HOH.
For 2024 taxes filed in 2025, the head of household standard deduction is $21,900. For 2025 taxes filed in 2026, it's projected at $22,500.
Compare that to single at $14,600 for 2024.
Exactly. That's a $7,300 larger deduction right off the top compared to single. That's $7,300 of income that just isn't taxed if you take the standard deduction.
That's a huge difference in taxable income right there.
It's massive for many people. And then you add the wider tax brackets. Remember how the 22% bracket started around $47K for single filers in 2024? For head of household, the 12% bracket extends all the way up to about $63,000. Their 22% bracket doesn't even start until after $63,000 of taxable income.
So HOH filers can earn quite a bit more before hitting those higher rates.
Precisely. They get the double benefit, bigger standard deduction and more income tax at the lower 10% and 12% rates.
Let's use that Investopedia example again, $70,000 taxable income.
Right. In 2024, a single filer with $70 K taxable income owes about $7,241 in tax. A head of household filer with that same $70 K taxable income owes only $5,441.
That's $1,800 less tax just from the filing status.
A very real saving. And remember the Reddit example with just $25,000 income. The standard deduction difference was huge. Single filer paid tax on $10,400, $25K, $14, and $6K deduction. HOH filer paid tax on only $3,100, $25K, $21, $9K deduction. Their taxable income was slashed.
Okay, the message seems incredibly clear for unmarried people. If you have dependents and are paying the bills for the home, you absolutely need to check if you qualify for head of household. The savings over filing single can be substantial.
It's not just worth checking. It's almost a financial necessity if you might qualify. Don't leave that money on the table.
Got it. Okay, that covers single and the very advantageous head of household. Now let's shift gears to married couples. Two main options. Married filing jointly is the big one.
Yes. MFJ is overwhelmingly the most common status for married couples in the U.S. The main requirement, as we said, is just being legally married as of December 31st.
And how does it work in practice? Filing jointly.
It means you and your spouse combine everything onto one single tax return, all your income, all your deductions, whether standard or itemized, all your credits, all your tax payments made during the year. It's one consolidated picture.
Even if one spouse didn't work or have any income?
Yes, absolutely. You can still file jointly even if one spouse had zero income. You just combine the working spouse's income with the non-working spouse's, well, zero income and any shared deductions and credits.
What about the sad situation where a spouse passes away during the tax year?
The IRS rule is that you are considered married for the entire year in which your spouse died. So the surviving spouse can file married filing jointly for that specific tax year.
Even without kids?
Yes. For that year of death, MFJ is an option regardless of dependents. After that year, the surviving spouse might use qualifying surviving spouse status for a couple more years if they have a dependent child, or then switch to HOH or single.
That's good to know for people dealing with that loss. Now, something the sources really hammered on for MFJ was shared responsibility. What's the deal there?
This is probably the most critical thing to understand about filing jointly and potentially the biggest downside. When you sign that joint return, both spouses become equally and individually responsible for everything on it.
Meaning?
Meaning you're both responsible for the accuracy of all the income reported, all the deductions, all the credits claimed, and crucially, you are both responsible for paying the entire tax liability shown on the return, plus any interest or penalties that might arise later, maybe from an audit.
Even if my spouse was the one who earned all the income or made the mistake that led to the tax bill, I'm still on the hook for the whole thing.
That's exactly right. It's called joint and several liability. The IRS can come after either spouse for the full amount owed on that joint return.
Wow. Okay, that sounds potentially risky, especially if finances aren't fully shared or if there are trust issues.
It absolutely can be. It's a major reason why some couples, particularly those who are separated or heading towards divorce, or maybe where one spouse suspects the other might be hiding income or has old tax debts, might choose not to file jointly, even if it means paying more tax overall. There is something called innocent spouse relief, but the sources indicate it's often difficult to qualify for.
That shared liability is definitely a powerful factor to weigh against the potential tax savings.
It really is. For some, the security of separate liability is worth more than the dollars saved by filing jointly.
Okay, setting aside the liability issue for a moment, let's talk about why MFJ is so common. What are the usual financial upsides?
Well, in the vast majority of situations for married couples, filing jointly does result in the lowest combined tax bill compared to filing separately. There are a few key reasons. First, as we mentioned, the standard deduction for MFJ is the largest available.
What's the number again for 2024?
For 2024 taxes, it's $29,200. For 2025, it's projected to be $30,000. That's literally double the amount you get if you file single or married filing separately. So right away, a huge chunk of combined income is shielded from tax if you don't itemize.
Double the deduction for two people. That makes intuitive sense.
It's a major advantage. Second, the income tax brackets for MFJ are generally much wider than for single or MFS, especially in those lower and middle income ranges.
So more income stays in the 10% and 12% brackets.
Exactly. A larger slice of your combined income gets taxed at those lower rates before you bump up into the 22% bracket and beyond. While we saw the marriage penalty can bite high earners, for most couples, these wider brackets mean a lower overall effective tax rate compared to filing separately.
Okay, biggest standard deduction, wider brackets.
Yep. Access to credits and deductions. Filing jointly makes you eligible for a whole host of tax breaks that are often completely disallowed or severely limited if you choose to file separately. This is a really big deal.
Which kinds of breaks are we talking about?
Oh, major ones. We'll list them more specifically when we talk about MFS drawbacks, but think things like education credits, the child and dependent care credit, the earned income tax credit. A lot of valuable stuff is tied to filing jointly.
Got it. So MFJ, biggest deduction, usually better brackets, most credits available, usually lowest tax, but comes with that shared liability handcuff.
That's a good summary.
Yeah.
Which brings us naturally to the alternative for married folks, married filing separately.
Right. MFS, how does this one work?
Pretty simply, in concept, each spouse files their own completely separate tax return. You report only your own income, claim only your own deductions, or your share of joint ones, and calculate your own tax liability. You're treated almost like two single filers, but with special rules because you're married.
You said it's less common because it usually means more tax. So why would people choose it? What are those specific situations where MFS might actually be better?
The sources point to a few specific scenarios. One we already touched on is maximizing the medical expense deduction. Remember, you can only deduct medical costs that exceed 7.5% of your adjusted gross income, AGI.
Right.
If one spouse has huge medical bills, but the couple's combined AGI is very high, they might not meet that 7.5% threshold on a joint return. But if that spouse files separately, their individual AGI might be much lower, allowing them to clear the threshold and deduct a good chunk of those expenses.
Let's walk through that TurboTax example again.
Okay. Spouse A earns $50K, spouse B earns $85K. Spouse A has $10,000 in medical expenses. If they file jointly, their AGI is $135,000. The deduction threshold is 7.5% of that, which is $10,125. Since spouse is $10 expenses are less than the threshold, they get no medical deduction on a joint return.
Okay, then jointly.
Now, if spouse A files separately, their AGI is just $50,000. The threshold on their return is 7.5% of $50K, which is only $3,750. Since their $10,000 expenses exceed this lower threshold, they can deduct the difference. $10,000 minus $3,750 equals a $6,250 deduction on their separate return.
So filing separately unlocked a $6,250 deduction that was totally lost when filing jointly.
Exactly. That's a scenario where MFS can provide a clear specific benefit even if the overall tax might still be slightly higher. Another big one is income-driven student loan repayment plans.
How does MFS affect those?
Many of these plans, like IBR or PAYE, calculate your required monthly payment based on your AGI and family size. If you file jointly, your payment is usually based on your combined AGI, which could be quite high, leading to a higher monthly payment.
But if you file separately?
If you file separately, in many cases, the payment is based only on your individual AGI, the borrower's AGI. If your income is much lower than your spouse's, filing separately could drastically reduce your required monthly student loan payment.
That sounds like a complicated trade-off. Lower student loan payment now, but potentially higher taxes overall.
It absolutely is. You have to run the numbers carefully, compare the tax cost of filing separately versus the savings on the student loan payments. Sometimes the loan savings outweigh the tax hit, sometimes they don't.
Okay, medical expenses, student loans. What else?
The liability issue we discussed. Filing separately means you are only responsible for the tax, interest, and penalties related to your own return. You're completely shielded from any issues on your spouse's separate return.
So peace of mind, especially if you're separated, getting divorced, or just worried about your spouse's financial dealings or past tax problems.
Precisely. It creates a clean financial break for tax purposes for that year. And one more complexity the sources mention, community property states.
Right, places like California, Texas, Arizona.
Yes, those 9 states. Filing MFS in a community property state is significantly more complicated. Why? Because state law generally treats income earned and property acquired during the marriage as owned equally, 50-50, by both spouses, regardless of whose name is on the paycheck or the title.
So even if I file separately, I might have to report half my spouse's income, and they report half of mine.
Generally, yes. You often have to allocate community income and deductions according to specific state rules, which can be very complex. It's not just reporting what you personally earn.
Sounds like you definitely need professional tax help if you're filing MFS in a community property state.
Almost certainly advisable, yes. It's a whole different ballgame there.
Okay, so those are the potential reasons to file MFS. What are the big downsides, the rules that usually make it the less attractive option overall?
There are several pretty significant drawbacks. Probably the most well-known, or maybe infamous, is the rule about itemized deductions.
The both or none rule.
That's the one. It's critical. If one spouse filing separately chooses to itemize their deductions, maybe they have high medical bills or enough mortgage interest and state taxes to exceed their MFS standard deduction, then the other spouse must also itemize deductions on their separate return.
Even if the second spouse has hardly any itemized deductions, they can't take the standard deduction.
Correct. They are forced to itemize. Even if their itemized total is tiny, maybe just a few $100s, they lose out completely on their MFS standard deduction, which was $14,600 for 2024, simply because their spouse chose to itemize.
Ouch. That could dramatically inflate the tax bill for the spouse with few deductions.
It's a huge penalty baked into the MFS rules and a major reason why the combined tax is often higher. Also, if you do itemize and have shared expenses like property tax or mortgage interest on a home you own jointly, you have to agree on how to split those deductions between your 2 separate returns. You can't both claim the full amount. The total claimed across both returns can't be more than what would have been allowed on a joint return. Usually you split it based on who actually paid it, or maybe 50-50 if paid from joint funds.
More record keeping and potential for disagreement.
Can be. Now, standard deduction for MFS if neither itemizes.
We said it was half the joint amount, right?
Exactly. For 2024, it's $14,600 each, same as the single filer amount. So combined, you get $29,200, just like MFJ, but only if neither of you itemizes. If one itemizes, the other gets zip for the standard deduction.
So you lose the big joint deduction benefit and might get hammered by the itemization rule. What else?
Another limitation is on deducting capital losses. If you file jointly, you can deduct up to $3,000 of net capital losses against your ordinary income each year. If you file separately, that limit is cut in half, only $1,500 per spouse.
Another small nick. It's adding up.
It does, but the really big financial hit from MFS, beyond the standard deduction and itemizing rules, is the loss of eligibility for so many common and valuable tax credits and deductions.
Okay, let's list those out. Which specific tax breaks are generally off limits if you file MFS?
It's a pretty significant list, unfortunately.
Okay.
Key ones include the Child Independent Care Credit for work-related child care costs, usually gone. Education credits like the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC, generally not available. The Earned Income Tax Credit, EITC, this is a huge one, a major refundable credit for low to moderate income workers, especially with kids, almost always unavailable if MFS.
Losing the EITC alone would make MFS a non-starter for millions of families.
Absolutely. It can be thousands of dollars lost. Others include the adoption credit, typically lost. The deduction for student loan interest paid. You usually can't deduct it if MFS. Certain exclusions for interest from U.S. savings bonds used for education. The amount of Social Security benefits that might be tax-free is often reduced. Deductibility of IRA contributions can be limited more severely based on income if MFS.
Wow. Okay. child care credit, education credits, EITC, adoption credit, student loan interest deduction. That's a brutal list of commonly used tax benefits you forfeit by filing separately.
It really is. It highlights the significant financial trade-offs. You gain that separate liability and maybe a specific advantage for medical bills or student loan payments in niche cases.
But you almost always pay more overall tax because you lose the bigger standard deduction or get forced to itemize poorly, face potentially narrower brackets, and give up access to a whole suite of valuable credits and deductions.
That sums up the MFS dilemma perfectly. It's why it's generally the less common and often less financially sound choice for married couples.
So, given all this complexity, especially comparing MFJ versus MFS, what's the practical advice from the sources?
The advice is unanimous and clear. If you're married, you should really calculate your taxes both ways before you file. Run the numbers as married filing jointly and run them as married filing separately. See which one results in the lower combined tax liability for the two of you.
Don't just assume MFJ is better, even though it usually is.
Exactly. Your specific situation, income levels, deductions, credits you qualify for, those potential MFS benefits like medical or student loans, and your tolerance for shared liability might make MFS the better choice or might confirm MFJ saves you money. The only way to know for sure is to compare.
How can people easily do that comparison?
Most decent tax software programs will do this for you. You enter all your information, and there's usually an option or feature that calculates the results for both MFJ and MFS side by side, telling you which status is more beneficial from a purely tax dollar perspective.
Or talk to a professional.
Or talk to a qualified tax professional, yes. They can run the comparison and also help you weigh the non-tax factors, like the liability issue, especially if your situation is complex or involves community property rules. But doing that comparison one way or another is crucial.
That really seems like non-negotiable advice for married filers. Could save hundreds, maybe thousands.
Easily. Or confirm you're making the right choice based on other priorities, like liability. It's about making an informed decision.
Okay, great. We've hit the main four statuses hard. Before we wrap up, any other quick but important points related to filing status that came up in the sources?
Yeah, just a couple of loose ends. We briefly mentioned qualifying surviving spouse earlier. Just to recap, this status can be used for up to 2 years after the year a spouse died.
Requirements.
You can't have remarried, and you must have a dependent child living with you for whom you pay more than half the cost of keeping up the home.
And the benefit.
The big benefit is you get to use the favorable married filing jointly tax brackets and the large MFJ standard deduction, $29,200 for 2024 for those 2 additional years. It provides a cushion before you likely switch to head of household if you still have the qualifying child. Or single.
A helpful transition status. Good. What else?
Just a quick reminder on the dependent definition, since it's so key for head of household and many credits. Remember those core tests: relationship, age, with student disability exceptions, residency, living with you half year, support, you provide half, and they can't generally file a joint return themselves. The sources stress making sure someone truly meets the IRS definition, not just your personal definition of dependent.
Right, the IRS rules are what matter.
Exactly. And then a really practical point, your W-4 form at work, your withholding.
How does filing status affect that?
Your filing status is a key input on Form W-4, which tells your employer how much federal income tax to withhold from your paychecks. If your filing status changes, especially if you get married, you need to update your W-4.
Why is getting married such a big deal for W-4s?
Because if both spouses work and you both just check married filing jointly on your W-4s without further adjustments, the standard withholding tables might assume your combined income only needs to cover one set of MFJ deductions and brackets. This can lead to under withholding throughout the year.
Meaning you get hit with a big tax bill when you file.
Very common scenario. The IRS actually encourages married couples where both work to consider using the married filing separately, withholding rate on their W-4s, or using the specific checkbox for multiple job spouses working, or using the IRS's online tax withholding estimator tool. These methods generally result in more accurate withholding closer to your actual joint liability.
So don't just change to MFJ on the W-4 and assume you're good if both spouses work. You might need to withhold more.
Definitely check it using the IRS tool or consult the W-4 instructions carefully. It prevents nasty surprises. And one final point, amending returns.
Can you change your filing status after you've filed?
Sometimes. There's a key rule here. If you initially filed as married filing separately, but then you realize, oops, we would have saved a lot more filing jointly, you can generally amend your return.
How?
You file Form 1040X, amended U.S. individual income tax return, and change your status to married filing jointly. You usually have 3 years from the original due date to make this change.
Okay, so you can switch from separate to joint later. What about the other way?
Generally, no. Once you file as married filing jointly, you typically cannot amend your return after the tax filing deadline to change to married filing separately.
Ah, so that decision to file jointly is pretty much locked in after the deadline.
Largely, yes. It really underscores the importance of doing that MFJ versus MFS comparison before you file if you're married and have any doubts. You can fix MFS to become MFJ, but you usually can't undo MFJ to become MFS.
That makes total sense. A very important practical point.
It is.
All right, this has been a really thorough deep dive. We've walked through the main U.S. tax filing statuses: single, head of household, married filing jointly, and married filing separately. We've seen how crucial that December 31st date is for determining your marital status for the whole year.
And we really dug into head of household, understanding who qualifies, needing to be unmarried or considered unmarried, that key exception for separated folks, having that qualifying person, paying more than half the home costs, and the big payoff, much better standard deduction in tax brackets than single.
Yeah, the HOH benefits are clear. Then for married couples, we contrasted married filing jointly, the most common, biggest standard deduction, best access to credits, usually lowest tax, but with that significant joint and several liability.
Against married filing separately. Less common, usually higher tax, smaller standard deduction each, that tricky both or none itemization rule, losing lots of credits. But offering separate liability and potential specific benefits in niche cases like high medical bills or some student loan situations. And we flagged the extra complexity in community property states.
The key takeaway feels really clear. Your filing status isn't just some minor detail. It's a cornerstone of your entire tax calculation. Choosing the correct status based on your actual situation on December 31st is absolutely essential.
Absolutely. And for married couples, that extra step of comparing MFJ versus MFS, running the numbers, understanding the trade-offs, especially liability versus tax breaks, is so important. Life changes, kids, jobs, health, loans can shift the calculation, so it's worth reviewing. Don't just default. Understand your choice.
It really is striking how much financial impact this one decision your filing status can have. Which I guess leads to a broader thought.
Yeah.
If something seemingly as basic as filing status has all these nuances and financial consequences, it makes you wonder, right? What other parts of the tax code, maybe things that seem like just procedural details, might actually hold similar hidden complexities or opportunities or pitfalls that are really worth a closer look?
That's a great point. The tax code is full of details where significant financial implications lie just beneath the surface. Understanding one area often makes you curious about others.
Definitely something for you, the listener, to ponder. What else in your financial life might deserve a deeper dive? Well, that wraps up our exploration of U.S. tax filing statuses for today. We really hope this conversation helps clear up some confusion and gives you more confidence navigating this part of your taxes.
Yeah, getting these fundamentals down is a huge step towards being more financially savvy and planning effectively.
Keep exploring those details, keep asking questions, and we'll be back next time to unpack another fascinating topic with you.